welcome to this passage. Okay, I'm online now. 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 Welcome to this passage. Welcome to this passage. Okay, I'm online now. Okay, online now. Welcome to this passage. Okay, online now. Okay, online now. Welcome to this passage. Welcome now. Okay, online now. Okay, online now. Welcome to this passage. Okay, online now. Okay, online now. Welcome to this passage. Okay, online now. Okay, online now. Okay, online now. Welcome to okay, online now. Okay, online now. Okay, welcome to okay, online now. Okay, online now. Okay, welcome to okay, welcome to okay, online now. Okay, welcome to okay, welcome to okay, welcome now. Okay, online now. Okay, welcome now. Okay, welcome now. Okay, welcome now. Okay, online now. Okay, welcome now. Okay, welcome now. Okay, welcome now. Or per unit. Yes. 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 Chimaobi, Onwaha. Good morning. Chimaobi, Onwaha. Good morning. Chimaobi, Onwaha. Good morning. Chimaobi, Onwaha. Good morning. How are you today? Shimobi Onwaha, good morning. How are you today? Shimobi, you can chat me up on the comment section. Good morning. How are you today? Shimobi, you can chat me up on the comment section. Good morning. How are you today? Shimobi, you can chat me up on the comment section. Good morning. How are you today? Okay, I can see Juliet. Shimobi, you can chat me up on the comment section. Good morning. How are you today? Wednesday. Okay, I can see Juliet. You can chat me up on the comment section. Good morning. Good morning all. How are you today? Wednesday. Okay, I can see Juliet. You can chat me up on the comment section. Good morning. Good morning all. How are you today? Hearing me well. Wednesday. Okay, I can see Juliet. You can chat me up on the comment section. Good morning. Good morning all. How are you today? Hearing me well. Wednesday. I see today. Okay, I can see Juliet. You can chat me up on the comment section. Good morning. Good morning all. How are you today? Hearing me well. Wednesday. I see today. Can you see the screen? Juliet. You can chat me up on the comment section. Good morning. Good morning all. How are you today? Hearing me well. Wednesday. I see today. Okay, can you see the screen? You can chat me up on the comment section. Good morning. Good morning all. How are you today? Hearing me well. Wednesday. I see today. Okay, can you see the screen? You can chat me up. Juliet. Good morning. Good morning all. How are you today? Hearing me well. Wednesday. I see today. Okay, can you see the screen? You can chat me up. Juliet. Good morning. How are you today? Hearing me well. I see today. Okay, can you see the screen? You can chat me up. Juliet. Good morning. How are you today? Hearing me well. I see today. Okay, can you see the screen? Can you hear me? You can chat me up. Juliet. Good morning. How are you today? Hearing me well. I see today. Okay, can you see the screen? Can you hear me? You can chat me up. Juliet. Good morning. How are you today? Hearing me well. I see today. Okay, can you see the screen? You can chat me up. Juliet. Good morning. How are you today? Hearing me well. I see today. Okay, can you see the screen? You can chat me up. Juliet. I see today. Okay, can you see the screen? I see today. Okay, can you see the screen? You can chat me up. Juliet. I see today. Okay, can you see the
I'm trying to work on this thing, on the noise. Can you hear me? Has the noise stopped? On the noise. Can you hear me? Has the noise stopped? On the noise. Can you hear me? Has the noise stopped? Okay, the noise has stopped, right? 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 Good morning, my students. Welcome once again to another session with you. Good morning, my students. It's a pity I have to drag you people to welcome once to study to during holidays. Another session with you. But we have to cover this my students. Outline. I have to drag you people to because exam is very fast approaching. But we have to next week now. We'll be thinking of exam outline. Like I said, we're going to talk about accounting for government grants and disclosure of government assistance. Like I said, we're going to talk about in April 2001, the International Accounting Standards Board adopted IAS 20, accounting for government grants and disclosure of government assistance, the International Accounting Standards, which had originally been issued by the International Accounting Standards Committee in April 1983. Other standards have made minor consequential amendments to IAS 20, which include IFRS 13 fair value measurement, presentation of items of other comprehensive income. Also, when IAS 1 was amended in June 2011, it also affected it. Then IFRS 9, financial instruments, hedging accounting as amendments to IFRS 9. Then IFRS 7, which is also talking about financial instrument disclosure, and as all the issues are brought in which is also talking about impacted the IAS 20. All the issues. We're going to look at the following terms as used in the standard. Government in this standard refers to governments, government agencies, and similar bodies, whether local, national, or international. In this standard, so these are the people that we concentrate on when we say government. Then government assistance is action by government designed to provide an economic benefit specific to an entity or range of entities qualifying under certain criteria. Now, this is not an action that is taken by government to cover the whole populace, the public, but it has to be either a specific entity or a range of entities to cover the whole populace, the public. Government assistance for the purpose of this standard does not include benefits provided only indirectly through action affecting general trading conditions, such as the provision of infrastructure in development areas or the imposition of trading constraints on competitors. So these ones are not actually part of the government assistance because it's like a general action taken, and it will be difficult to measure the benefit derived from it. It's so important that we must be able to measure benefit derived from the government assistance before we can regard it as such. Government grants are assistance by government in the form of transfers of resources to an entity in return for past or future compliance with certain conditions relating to the operating activities of the entity. So we are talking about transfer of resources to an entity. So we already know what resources are. Economic resources like assets. Assets could be in money or could be in material thing, so long as they bring benefit to the company and they flow from past activity of the company and can be controlled by the company. We know that these are economic resources of the company. They include those forms of government assistance which cannot reasonably have a value placed upon them, and transaction with government which cannot be distinguished from the normal trading transactions of the entity. Sorry, let me answer your student. Yes, Mercy. Good morning. We are live.
Doctor, how are you?
Fine, thank you. Yes, Mercy. I will call you. We are live. You can join.
Doctor, how are you?
Fine, thank you. Grants related to assets are government grants whose primary condition is that an entity qualifying for them should purchase, construct, or otherwise acquire long-term assets. Subsidiary conditions may also be attached, restricting the type of location of the assets or the periods during which they are to be acquired or held. So these are conditions that has to pass through before an entity qualifies. So from what we have seen that in here, it's a condition is that an entity qualifying for them should purchase or construct or otherwise acquire long-term assets. Subsidiary condition may also be attached, restricting the type or location of the assets. So this is to be sure that government is not giving out grants that the person will use in another thing. So they have to be sure that you are really using the grant for the purpose for which it was meant. So that's why all these conditions are very, very important. For which it was meant. So that's why all these conditions are very, very important. Grants related to income are government grants other than those related to assets. We have looked at grant related to assets, and then we are now looking at grants related to income. Any grant that is not related to assets then is related to income. Then we also have forgivable loans. These are loans which the lender undertakes to waive repayment of under certain prescribed conditions. These are loans which the lender, of course, we also know what fair value is, the price that will be received to sell an asset or paid to transfer a liability, of course, in an orderly transaction between market participants at the measurement date. We know that in this era of IFRS, a lot of things are valued are measured using fair value. We know that in this era there are only few things that may have to be measured in a different way. But assets and liability now are measured in fair value. So we look at the form of government assistance. Government assistance takes many forms, varying both in the nature of the assistance given and in the conditions which are usually attached to it. Of course, like I said before, every assistance that government gives, there must be conditions. That's why they seek for qualifying entity. If the entity does not qualify, then the entity cannot get the grant or the assistance, as the case may be. The purpose of the assistance may be to encourage an entity to embark on a course of action which it will not normally have taken if the assistance was not provided. It's a form of encouragement that government gives you grants or gives you assistance, is to encourage you to go into things that you will not ordinarily have gone into if not for the assistance that they have given. Why should we specially account for government assistance or government grant? The receipt of government assistance may, by any entity, may be significant for the preparation of the financial statement for two reasons. Firstly, if resources have been transferred, an appropriate method of accounting for the transfer must be found. Of course, we know that it's transfer of resources, which I try to explain, that could be in material form or in monetary form. So once such transfer is made, it's expected that it should be accounted for appropriately, so that the impact of that transfer of resources will be known. This will also help them to see whether they can continue to give the assistance or to stop. Secondly, it is desirable to give an indication of the extent to which the entity has benefited from such assistance during the reporting period. This facilitates comparison of an entity's financial statements with those of prior periods and with those of other entities. Of course, we want to see that the assistance that was given has caused a change, a positive change, when you compare to the previous years that you did not have the assistance, or when you compare with other entities that do not have the assistance. Government grants can be sometimes called by other names, such as subsidies, subventions, or premiums. So you can place government grants with all these names, such as subsidies, subventions. Condition for recognizing government grant. Initial recognition. Government grants, including non-monetary grants at fair value, shall not be recognized until there is reasonable assurance that, including non-monetary, these are two things that must be there before we talk about recognizing government grants. The entity will comply with the conditions attaching to them. Like I have said before, the entity will government grants are not given without conditions. There must be conditions that are given. So if government grants are not, you have to be very sure there must be conditions that are given. The conditions attached to the government grant will be complied with before you start recognizing them in the book. Attached to the government grant will be complied with before you start recognizing them in the book. The grants will be received. So it's not only that you meet the condition, it also have to be that you are certain that this grant will be received. It's not only that you are certain that this grant will be received. It also have to be that you are certain. This is the only way you can start recognizing government grant. If not, it's not only way you can start required that you recognize government grant. If not, it's not only way. Okay, government grants shall be recognized in profit or loss on a systematic basis over the periods in which the entity recognizes as expenses the related costs for which the grants are intended to compensate. So we can see that here said the standard says that it should be recognized systematically over the periods. So if the grant is given for something, let's say an asset that will last for 5 years, the grant should also be recognized over that 5 years. If it's an expense that will be incurred for over a period of time, it has also to be recognized over that period of time. So the grant is attached to that 5 years, whether it's an asset or an expense that is set to cushion. So the grant is attached. So there are two broad approaches to the accounting for government grants. The first one is the capital approach, under which a grant is recognized outside profit or loss, and the income approach, under which a grant is recognized in profit or loss over one or more periods. So we have the capital approach. In this case, you will not see the grant in profit or loss, in the statement of profit or loss. Instead, it will be in the statement of financial position. There are reasons for this, and one of the assignments I will give you is go and find out the reason why this approach can be used. Instead, what is the benefit and what is the drawback? Then the second one is income approach, under which a grant is recognized in profit or loss over one or more periods. So these are the two broad approaches to the accounting for government grants. The second one is, and then I have told you, go and give me the over one or more. Go and give me arguments for and against these two approaches. Let me type it in the comment section so that you know what you have to do. Go and give me go and give me arguments for and against these two approaches. Let me type it in the comment section so that you know what you have to do. Go and give me arguments for and against these two approaches. Let me type it in the comment section so that you know what you are talking about. Okay, that's said, let's continue. Accounting treatment of government grants related to assets. So we said that the grant can be related to assets or can be related to that's money. Said, let's continue. So we want to look at how the accounting treatment for grants related to assets can be done. So government grants related to assets, including non-monetary grants at fair value, shall be presented in the statement of financial position, either by setting up the grant as deferred income or by deducting the grant in arriving at the carrying amount of the asset. So we have two methods that we have seen here, which we are going to demonstrate in the illustration question. Or by deducting the grant. Say, government grants related to assets, including non-monetary grants at fair value, shall be presented in the statement of financial position, either by setting up the grant as deferred income. So we are going to look at setting up the grant as deferred income, or by deducting the grant in arriving at the carrying amount of the asset. These are two measures. The first one is you set up the grant as deferred income in your statement of financial position. The second one is you will deduct it from the carrying amount of the asset. Let's assume the asset is 500,000 and the grant is 100,000. Then you deduct it from the asset, the carrying amount of the asset of that 500,000, which means what we are going to have in the book there will be 400,000, while 100,000 has gone to the grant. So that's how it is. Or in the other way around, you recognize the asset the way it is, and then recognize the grant as deferred income. Example 1. So that's how it is. Or in the other way around, on 1st of January 2009, or the South Associates, I think we should use 2025, please. This thing, I'll correct it. Or the South Associates received a grant of 200,000 towards a machine costing 500,000. Or the South Associates depreciates machinery at 10% per annum on a straight line basis. Received a grant of 200,000 towards the question again on 1st of January 2009. That is what is there. It's not 2009, 2009. Or the South Associates received a grant of 200,000 towards a machine costing 500,000. Or the South Associates depreciate machinery at 10% per annum on a straight line basis. Account for this grant using the two alternative approaches acceptable for the initial recognition of the grant. Remember, the two approaches is one, you recognize the grant as deferred income, while the second one is you directly apply it to the asset that the grant was meant for. It could be asset, it could be expense. So this is the accounting for the two method. Apply it to the asset. We have bank debited to record the receipt of the money.
Accounting for the two
Bank debited, that's 200,000. The grant is 200,000. So you debit to a bank, then you credit deferred income.
to
Deferred income will be in statement of financial position, 200,000. Description is being separate treatment of grant in statement of financial position.
then you credit
Being separate treatment of grant in the statement of financial position.
200,000.
So this is the first approach that we are using,
Separate treatment of grant.
using treating it as deferred income.
Being separate treatment of
We
grant
debit bank to show the receipt of the
So this is the
money,
first approach
and then
we are
credit
using
deferred income
using
to
treating it
recognize
as
that
deferred
such amount has been received by government, from government,
debit bank
as grants
show the
to the
receipt
company.
of the so this is the
Money.
first
Or
approach and then
if we want to offset it against the asset,
using
we will still debit bank to show that such amount has been received
by government
by the company,
grants show the receipt
and then
or
we are going to credit the
if
plant
you want to offset it
and
against
machinery. That is
we will
the
still
asset
debit bank
that
to show that
was
such amount has been
property,
received
plant and machinery, PPE,
by
PPM, that
the
was
company
given the
And
grant.
then
So you see
we are
now,
going to credit the
when
plant.
you bought the asset, remember the conditions that you must either purchase, construct, or sell
property, plant and machinery
before you are qualified for that grant, to ensure that you don't take the money and don't
So
use
you
it.
see now,
So remember that when the property was acquired,
remember
it was debited
you must
and
either
cash
purchase,
was
construct,
credited
or sell
to show that
before
a property has been acquired,
to ensure that
the machinery has been acquired.
money and
So now, by the time you credit the machinery, what you have done is reduce the value of the machinery by the amount of grant that was given. Reduce the value of the machinery by the amount of the grant that was given.
so now
So
by the time
since that machinery was
is reduce the value
500,000, what you are going to have now is 300,000
given
because you have
reduce the
reduced
value
it.
of the machinery by the amount of the grant.
In accounting for the grant, in example 1
So,
above, or the
since,
South Association will
that
make the following annual entries.
reduce the value 500,000
So this is what is going to happen.
is 300,000.
Remember that the machinery at the end of the year,
In accounting for
there
the
will be
grant,
depreciation.
example 1 above,
There will be
South
depreciation.
Association will make the following
So
annual
the depreciation will be in income statement. So the journal we have here is you debit depreciation
remember that
by 50,000.
the
Remember
machinery
that
at the end of the
it's
year
going to be the
there will
question
be
says that
depreciation.
the
There will be depreciation.
asset is depreciated
So the depreciation will be in income.
using a straight line method
The journal
at the
will
rate
have here
of 10%
is you debit
per
depreciation.
annum.
Remember
At the
that
rate of
by
10%
50,000.
per
Remember
annum.
that at the end
So if you apply 10% on 500,000, you have 50,000. You have 50,000.
straight line method
At the rate of 10%. So which means this asset will be depreciated over 10 years or so.
So if you apply 10%
On then this 50,000 will be charged to profit or loss. That's why you see income statement there.
this asset
Then you credit accumulated depreciation to complete the
this
double entry.
50,000 will be charged to profit or
Then
loss.
from the
That's
deferred
why
income
you see
account
income statement.
that we credited
Then
200,000,
credit accumulated
we will take
depreciation.
20,000 from it.
Then this
So that is why we debited the deferred income
then from the
account
deferred
in
income
the statement
account
of financial
that we
position,
credited
and then credited income, other income, other income,
from it.
to show that we have received
That's why
the
debited the deferred
we have
income
received the grant for that year.
in the statement of financial
Remember that we said that
then
it should be
credited
accounted for
income,
systematically over
other
the period
income,
in which the grant will
other
last.
income.
to show that asset that is benefiting from the grant will last. So we are also going to use 20%, 10% of 200,000, which is 20,000, and we will take that as other income in the income statement, being annual entries when the grant and asset have been kept separate in the statement of financial position. That is the description. 20,000. So this is if we recognize the grant as deferred income. So look at the account that have been introduced here. We have the depreciation expense account and then accumulated depreciation. So this is then we have the deferred income account and we have the other income account. Now the deferred income account is the account where we warehouse the grant when it was given to us or the company. When they received it, they placed it at deferred income account by debiting cash and crediting deferred income account. At that point, they have not realized that income. So on yearly basis, they will take systematically the amount that is due for that year. Since it's at 10%, in relation to the asset that the grant is covering, it will also be the same rate of that 10%. So that's why we have 20,000. In relation to the asset that the grant is covering, it will also be the same rate of that 10%. So that's why we have 20,000. Yes. In relation to the asset that the grant is covering, no, it will also be the same rate. Is it strong? That's why we have Yes. Is it strong? Is it strong? No. Is it strong? Okay, the question that Ahar Rawa Lucian asked, that's what we are looking at. If you look at, let me go back to this place. Okay, the question we said that there are two ways of treating it. If you look at your screen now, either by deferred income or by deducting the grant in arriving at the carrying amount of the asset. So if we are using the second method, we definitely will reduce the value of the asset. That's why when you go to the journal here, you see the first method, the asset is not involved. It is in the second method that the asset is involved. The first method only looked at deferred income. That's why when you go to the journal here, you see the first method. The second method is the one that affects the asset directly. So the asset is reduced. If you look at it, bank is debited with 200,000 and the asset is credited with 200,000. That credit on the asset meant that the asset has been reduced. So the asset is reduced. I don't know whether your question is answered. Debited with 200,000 and the asset is credited with 200,000. That credit on the asset meant that Aharanwa, is your question answered? I don't know whether your question is answered. Okay, so let's go on. Let me know if your question is answered or if it's not yet answered. Okay, so that's the first one. Then the second one is depreciation expense 30,000 and accumulated depreciation 30,000 credit. Okay, so that's the first one. Then the second one is depreciation being annual entry when grant has been offset against assets in the statement of financial position. So you now see that the depreciation expense now becomes 30,000 when grant has while accumulated depreciation becomes 30,000 too. So you now see that the depreciation expense now becomes 30,000. I hope we are following. Remember, the first one is 30,000. So you now see that the depreciation expense now becomes 30,000. I hope we are following. Remember, the first one is 30,000. Explain. That's where I'm trying to. That's why I'm responding to it. I hope we are following. If I don't play it, I won't respond to it. Remember, the first one is. Explain. That's where I'm trying to. That's why I'm responding to it. Okay. 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 Okay, so I was trying to adjust the audio. I don't know whether you are still having problem with the audio. Okay, so I was trying to adjust the audio. I don't know whether you are still having problem with the audio. Okay, so I was trying to adjust the audio. I don't know whether you are still having problem with the audio. Okay, so we have looked at depreciation expense, accumulated depreciation, the annual entry for the two approaches, the one for deferred income and the one that relates to we have looked at depreciation expense. The grant is related to depreciation, the annual entry. Okay, presentation of grants related to income approaches, the one for deferred income and the one that relates to we have looked at depreciation expense. The grant is related to depreciation, the annual entry. Okay, presentation of grants related to income approaches, the one for deferred income. Grants related to income are presented as part of profit or loss, either separately or under a general heading such as other income. Alternatively, they are deducted in reporting the related expenses. So in this case, if government pays money to a company as grant, not assets, but pays money, we are going to account for it in this way. That is to present it as part of profit or loss, either separately or under a general heading such as other income. So it can be classified as other income or separately, presented separately. On the alternative, you can also deduct it directly from the expenses that the grant relates to. So let's look at example 3. Timnat Limited has been guaranteed a government grant of 40,000 as a reimbursement of training costs, which have been expensed during 2020. The grant will be recorded as income in 2020, either by including the grant under a separate heading such as other income, or offsetting the grant against costs. So we have seen that two ways it can be handled in two ways. It can be handled in two ways. The first one is to have a separate heading called other income that you are going to put the grant, or you offset it directly against the expenses. Know that when an entity qualifies for grant, the grant may not have been there, may not have been received. We said before we recognize grant, two things must uphold. One, the entity must be sure that they can comply with the requirements, the conditions of the grant. And then the second one is that the entity must be sure that they can receive, that they will receive the grant. So that is the ways that, those are the conditions for recognizing grant in our books. Now we look at the ways that we have here. Hope you guys are hearing me. Please comment, let me know. Okay, thank you. So we'll continue. So using the first approach, we are going to put the grant in a receivables account. Mind you, this is not the normal trade receivables account. We can call it other receivables or grant receivables. It will be in our statement of financial position, and that will be 40,000. And then other income in our income statement, 40,000 will be credited. This is to recognize the grant that will be received. Since we have receivables, it means that the cash has not been received. We are expecting the cash to come. That's why we are using receivables account. Then in the other way round, if we don't want to recognize it in the other income, we can apply it directly to the expense that this grant is given for. They said the expense is a training cost expense. Training expense. This is a grant that government gives the entity in order to encourage them to carry out certain training. So in this case, we'll still debit receivables to show that we're expecting this payment. Remember that we are sure that we're going to receive this grant. If we are not sure, we will not have recognized it in our book. But since we are sure, we'll debit the receivables 40,000 and then the training expenses 40,000. So in this case now, if the total expenses on training was 100,000, by crediting training expenses with 40,000, what it means that the expense on that training has reduced to to 60,000. That's 100 minus 40. So this has gone ahead to reduce or offset. If the training value cost was also 40,000, it means I would have had zero on training. So we wouldn't have reported any amount as training. This is because the effect of the grant is able to cover 100% the cost of the training. So that's how it is. Any questions so far? Okay, let's look at repayment of government grants. A government grant that becomes repayable shall be accounted for as a change in accounting estimate. Look at IAS 8, accounting policies, changes in accounting estimates and errors. Repayment of a grant related to income shall be applied first against any unamortized deferred credits recognized in respect of the grant. To the extent that the repayment exceeds any such deferred credit, or when no deferred credit exists, the repayment shall be recognized immediately in profit or loss. So this is how it is treated. If it is related to income, then you have the deferred credit that we have there in the our statement of financial position will be the first that the repayment will be applied to. If that deferred credit cannot carry the payment, then you will expense the rest in the income statement, profit or loss, as an expense. So this is if it's related to income, if the grant is related to income. Repayment of a grant related to an asset shall be recognized by increasing the carrying amount of the asset or reducing the deferred income balance by the amount repayable. To the accumulative additional depreciation that would have been recognized in profit or loss to date in the absence of the grant shall be recognized immediately in profit or loss. So when you are repaying a grant, it's either the reducing the carrying amount is enough to repay it, or you are going to write off whatever difference in the profit or loss. Circumstances giving rise to repayment of a grant related to an asset may require consideration to be given to the possible impairment of the new carrying amount of the assets. So if the asset is impaired, it should also be considered. So let's take this illustration. Assume that the grant of 200,000 in example 1 above become repayable on 1st January 2020, 1 year after grant was received. 1. If the grant was originally recorded as deferred income, the following entries will be required. Okay, you see, it's 1 year after. So we have deferred income, we'll debit it with 180,000, while provision for grant repayment will be 180,000, being repayment of offset against remaining balance on deferred income. Remember that we have recognized 20,000 earlier on as income. So the carrying amount of the grant in the statement of financial position will be 180,000, since we have released 200,000 as other income in the first journal that we did. So the carrying amount will be 180,000. That is what we are going to use in deferred income. That's what's in the deferred income. So we are going to match it up against the provision for grants repayment. Then the second one is we are going to expense the other one in the income statement. So we have grant repayment expense 20,000, provision for grant repayment 20,000. So if you add this 20,000 to the 180,000, you have the 200,000. So what it means is that when you want to repay now, you have provision for grant repayment will be debited, and then cash will be credited to show that you have actually paid back the money. As it stands now, we are still making provision because the grant is due for repayment. So if you add the 20,000 and the 180,000, you have 200,000. So in the other one, you say being excess of grant repayment over balance remaining on deferred income. You can remember what we said before. Repayment of a grant related to income shall be applied first against any unamortized deferred credit recognized in respect of the grant, to the extent that the repayment exceeds any such deferred credit, or when no deferred credit exists, the repayment shall be recognized immediately in profit or loss. So that's the situation here. The first leg of what I read now is that 180. That was the balance there. And then the second leg that said it will be recognized in profit or loss is the second one, where we have 20,000 naira. So that is how it is. We first and foremost apply it to what we have in our statement of financial position, and then the balance in the statement, income statement. If grant was originally deducted from the carrying value of asset, the following entries will be required. So in this case, we have a property, plant, and equipment will be debited. Then provision for grant repayment will be credited. So this amount now, plant and property, equipment, has 200,000 debited to reinstate that value that was removed from it. To reinstate that value. So the plant that was recorded, I said if you remove that 200,000, it will be 300,000. The plant will now have another, the main value of 500,000 when you add the 200,000 that you removed. You added it back to the value of the machine. being increase of carrying amount of asset. That's the description. Then depreciation expense of 20,000 will be credited in the income statement. Remember that at that point, the depreciation was also considered because there was an other income that came in of 20,000 from the grant. Now it's no longer there, so you add it back to the depreciation expense because it was not depreciated earlier on because of the grant. Then accumulated depreciation 20,000, being depreciation originally avoided due to grant being offset against assets, now charged as an expense. So originally the depreciation was not applied because of the grant, but now that there is a repayment, you must remember to also add that depreciation that was not applied initially to in order not to bring confusion in the accounting or not to understate the depreciation charges. Repayment of grants relating to income. Repayment should first be applied against any unamortized deferred credit set up in respect of the grant. Any excess should be recognized immediately as an expense. Any excess should be recognized immediately as an expense. Example 5. Assume that on January 2021, the training expenses grant of 40,000, example 3 above, became repayable. The following entry will be required. Grant repayment expense will be 40,000 and provision for grant repayment in statement of financial position 40,000. So in such a situation, you have made provision to repay that expense. When the grant, to repay the grant, sorry, when the payment is finally made, you will debit provision for grant repayment and credit cash that is making the payment. Government grants do not include government assistance whose value cannot be reasonably measured, such as technical or marketing advice. Government assistance does not include the provision of infrastructure which is available on an ongoing indeterminate basis for the benefit of an entire local community, e.g. road building, transportation system, or communication network. This I had said at the beginning of the presentation. The significance of the benefits in the above examples may be such that disclosure of the nature, extent, and duration of the assistance is necessary in order that the financial system may not be misleading. So when a government grant is given in form of assistance that will benefit everybody, you may not be able to quantify the particular benefit that the company derives from that, except where you are able to measure it. If you cannot measure it, then you cannot recognize it. So if you are able to measure it, then you can disclose the benefit that was derived from it. Disclosure of government grant. The following must be disclosed. You can get this in IAS 20, paragraph 39. Accounting policy adopted for grants, including method of balance sheet presentation. This was lifted directly from the standards. So they still use balance sheet there. Then nature and extent of grants recognized in the financial statements, nature and extent of grants recognized in the financial statements, then unfulfilled conditions and contingencies attaching to recognized grants. So these are the requirements for disclosure. Okay, you take this exercise. From the example above, post all the transactions in the various accounts affected above using the two methods. So we have the asset account, we have other income, we have deferred expenses, depreciation, accumulated depreciation. These are various accounts that we mentioned in this. So you are going to post everything, post the transactions that we journalized above in this, and I want this thing submitted on Friday. So everyone here, we have succeeded in discussing government grant and disclosure of government assistance. So it's important that we do our personal studies in order to be able to understand this more, because you don't know, it might be part of the exams. So if there is any question that you have, you can go ahead and ask. Don't know. Any question? Part of the exam. So if there is any question, please send response. Send response for me to see. Are you guys there? Are we all there? Are we all there? Okay, ladies and gentlemen, I think we have done so well. The next time, the next time we will see, maybe if next Friday is open, we will see and discuss. If it's not open, we'll still meet and then we'll discuss the exam questions. Yeah, you are asking if you can get the presentation. Yes, I'm going to share it public in the YouTube, in YouTube. So you go to my page and download it. You can use it from there, from my YouTube session, my YouTube channel. Go there and you have it there. So thank you very much. I appreciate your being here and joining in the class. I hope that you are able to learn something. I wish you the best of the holidays. You've done very well. Thank you very much. Vicky, take charge. Coordinate well.